The One Big Beautiful Bill has officially become law. President Trump signed it on July 4, 2025. It is now Public Law 119-21. This is a large, complex tax package. Its main goal: change the American tax system in significant ways. It takes many tax rules passed in 2017 and tries to make them permanent. It's one of the biggest federal tax shifts since 1986. The law aims to create simpler, more unified rules for taxpayers. The name promises clarity and broad benefit. This law matters to almost every American. It can change how much money people keep from their paychecks. It will affect how the government funds key services. Healthcare. It will affect how the government funds key services. Infrastructure. The bill's financial choices will impact the federal budget and the national debt for years. The legislation touches families with young children, retirees, small business owners on Main Street, large corporations in major cities. Its journey to law was not simple. It faced a challenging path through Congress. The Senate passed at 51-50, with Vice President J.D. Vance casting the tiebreaker. The House passed at 218-214. Democrats in both chambers opposed it unanimously. A major provision is the extension of the lower income tax brackets first introduced in 2017. This means many people's tax rates will not increase as previously scheduled. For example, 12% bracket, 22% bracket, both remain in place for many middle-income earners. The law also continues the enhanced standard deduction, likely remaining at the nearly doubled 2017 level. For a married couple filing together, this means they can reduce taxable income by a large, fixed amount without itemizing. This simplifies filing for a majority of American families. Instead of tracking every single medical expense, charitable donation, many can simply take the higher standard deduction. This is helpful for families without large mortgage interest payments or state and local tax bills to deduct. For families with children, the child tax credit remains a critical piece of the tax code. The bill aims to keep the credit at a generous level, potentially $2,000 per child. The refundable portion of the credit could be increased. Another key component is a new tax break for senior citizens. The bill introduces an additional $6,000 deduction for individuals 65 or older scheduled for tax years 2025 through 2028. It's targeted relief for a growing demographic facing pressures like rising healthcare costs and inflation hurting their savings. Another central theme is targeted tax relief for workers. A significant new provision allows for tax deductions on qualified tips, overtime pay. This is a major change for people in the service industry and for hourly workers who often rely on this extra income. The goal is to let these workers keep more of the money they earn from putting in extra hours or providing excellent service. These changes directly affect the take-home pay of millions of Americans in common jobs. One major part of the bill reduces IRS enforcement funding, cuts IRS hiring expansion, focuses audits mainly on high-income returns. This could mean fewer audits for small businesses, gig workers, independent contractors, but more focus on millionaires, foreign income, crypto transactions. Proponents say it makes the system fairer by concentrating scrutiny on the most complex finances. However, it raises questions about whether the agency will have enough resources to police tax compliance across all income levels. One potential side effect of the new law is the increased use of automated verification systems. This could mean that the agency will request more documentation to verify identities or confirm eligibility for certain tax credits, like the Earned Income Tax Credit. As a result, some tax refunds might be delayed while the IRS cross-references information. It is more important than ever for taxpayers to keep meticulous records to respond to any such requests promptly and efficiently. A reduced audit rate does not remove penalties. The IRS will still look for red flags, and penalties for late or incorrect filings remain. Married couples filing jointly, families with many dependents, self-employed, doctor office, cleaning business owner, landscaping or gardening service, handyman or maintenance worker, construction subcontractor, barber or hairstylist, online seller, graphic designer, photographer, website designer, Uber, taxi, trucking, childcare, home care. Refund amounts may increase for child tax credit, earned income credit, dependent deductions. But stricter identity verification is expected, meaning more document checks. For many families, the combination of credits and deductions can lower what you owe or raise your refund. Self-employed households should track mileage, home office, and equipment to capture full benefits. If identity checks arise, respond quickly with organized documents to avoid delays. Overall, benefits concentrate where there are dependents or legitimate business deductions to claim. Preparation and documentation remain the key to maximizing family outcomes under the law. Be proactive, not reactive. Winners: middle-class families, small business owners, married couples, high-income entrepreneurs using deductions, real estate investors, child care, home care, trucking, cleaning, and consulting businesses. Married couples who file jointly benefit from the doubled standard deduction and simplified filing. Small business owners: the continuation of the 20% qualified business income deduction is a huge victory. Real estate investors often benefit from provisions around property ownership and management. Losers: very low-income taxpayers with no dependents. High-income W-2 earners in CA, NY, NJ may be constrained as the SALT cap stays at $10,000. People who do not itemize deductions may see limited incremental benefit. People who file late or incorrectly, penalties remain. The law creates a new set of financial winners and losers, and understanding where you fall is essential. Consult a tax professional to map your situation to the new rules. Plan proactively to land on the winning side wherever possible. These laws may start 2025 or 2026, but you must prepare earlier. Maximize 2025 deductions before they expire. Set up LLC or S-Corp now to use QBI. Track mileage, home office, equipment. Prepare real estate or business investment strategy. Save proof of income and expenses. Use retirement accounts. 401k, SEP, Solo K. Consider hiring a tax professional. Don't wait until 2026. Big rule: do tax planning in November, not April. Before the year ends, review your financial situation and look for last-minute actions to lower your tax bill. Make a charitable donation. Contribute to a health savings account. Realize a capital loss to offset gains. If you're self-employed, evaluate your business structure now to take full advantage of the 20% QBI deduction. You may need to operate as a specific type of entity. Talk with a tax professional or business lawyer to decide which structure fits your goals and income. Keep careful and consistent records. Track expenses meticulously. Keep detailed logs of business mileage. Save all receipts. Document home office expenses. Use a spreadsheet or a dedicated app to make this process easier. Clear records help you claim every deduction and prepare you if the IRS asks for proof. Contribute to tax-advantaged retirement accounts, 401k, IRA, to lower taxable income while building wealth. Schedule a meeting with a trusted tax professional well before year-end to create a personalized plan. The One Big Beautiful Bill Act could reduce taxes for millions, but it's not final until Congress approves it. This is the biggest tax moment in years. Families: prepare your CTC and filing strategy. Small business owners: set up deductions now. High-income earners: plan for trust and estate changes. Immigrants: make sure your tax documents are correct and updated. If you want a full personalized 2025-2026 tax plan, comment "Plan My Taxes." Don't forget to like, subscribe, and turn on notifications. It merges many existing tax rules into one package, extends lower brackets, supports families and small businesses, refocuses audits, and demands better record keeping and planning. Remember, plan in November, not April. A short consultation with a qualified tax expert today can help you create a personalized plan to maximize your savings and ensure compliance. Stay informed. Keep your documents safe. Be ready to adapt to the new rules. Your financial future is in your hands. See you in the next video.